A very good day to all my viewers. My name is Rain, founder of Forex 100 Academy Private Limited. So today for the Art of Trading, episode number 2, we are going to cover the risk exposure and how you should be managing your trade. In trading, more often, a lot of times people are thinking it's a gamble or a luck factor does kick in, and to some of the superstitious people around, they'll be thinking of having to increase their luck so that they will trade better, they will be more profitable and stuff like that. Throughout more than 10 years of trading experience, I would say that in order for you to be a consistent profitable trader, you have to push the consideration of luck factor to the lowest, not highest. Why would I say so? Of course, with that said, that is in consideration, and make sure that your internet connection is stable. That is very important. Make sure when you execute your trade is being handled properly, meaning you say you enter a trade is being entered, be it selling or buying. And of course, when you choose to exit the trade, your trade is being exited. So of course, that is not in reference in the high volatility period where your US non-farm payroll, where you might have issues of trades, whether they are being engaged or not. That is a total different story. So beside that, you should actually look into putting your luck factor to the lowest possible. Why is that so? Luck basically is whether you choose the right trade, and a lot of times a right trade to a trader is whether it is a profitable trade. And of course, be it in business or trading, we love that all of the transactions we have are profitable, but often not, we all know that it is not the case. A good trade is when you follow your trade plan throughout from step 1 to whichever step you have, and for my case, there's around 4 to 5 steps minimum for a confirmation of a trade, or I'm looking to at least 4 indication before I engage the trade itself. And you shouldn't be filtering the trade based on whether you like it or not. Of course, if there is, let's say, a Brexit referendum, UK referendum itself to choose whether they are going to exit from the Eurozone, you can choose not to trade that, and you can stand out from all your existing trading plan if you do not prepare to have big swings in your results in profit or loss. However, apart from that, you should be engaging all your trade. When I say that, doesn't mean that you have to do it like 24 hours. You can even have time frame restriction. Let's say you're only trading a UK active timing or the US active timing, or based on your own available time, because FX is 24 hours. And when I say trading all, you should set a time cutoff and start of a trading duration every day, and it should be consistent. Apart from that, I do understand that some of your trading analysis or your strategy, like mine, can be just placing a pending order. A pending order is where you place your buy limit, sell limit, buy stop or sell stop before the market reaches the price itself. However, I do have traders saying things like, I want to maximize my usage of money. I want the money to work harder for me. So I would like to maximize the portfolio. I don't quite like just risking like 2% or 3% per trade. I just want my money to work harder. Or they will say that my capital is pretty limited. I only have $1,000. If I'm only going to risk 2%, I'll be earning like maybe $10 per trade, or even less than that. It could be possible. However, a lot of times I would say that risk management or equity management is very important. So when you say you're only going to risk 2%, or rather you want to risk more than 2%, you want to risk 20% of a portfolio, which that's the case for most traders who have not gone through a proper trading itself, or perhaps they are just high risk trader. They come into a factor of luck really does plays a part. Reason being, they can't take on all the trades, even they know that that trade does give a high returns, but because they have existing trade running, they can't exit the trade. They have to choose which trade to take. So my advice for you on that is that you can choose which currency pair or which time frame in specific you'll be trading, so you will reduce those issues. And of course, another method is for you to drop your risk exposure for every trade you are trading itself. And of course, the risk I'm using is between 1 to 3%, and of course for this example itself, I'll just use 2% as a guideline. A lot of times traders are saying things like, I'm not good in math, therefore I can't trade very well in Forex and stuff like that. To the contrary of the truth itself, FX trading has nothing to do with math. Basically, whatever that's required to calculate, I have already developed a calculator for all traders, not just my student, to use it for free. What you need to do is just to register an account with us on our website. When you are registered and approved verified user, okay, there's no need for you to pay anything for that. You will be able to use the risk calculator. Just punch in the number. It will be based on your capital, your risk that you want to expose per trade, and of course your stop loss for the trade itself. So I'll be introducing a few methods for you to use the calculator so you have a better understanding. And of course, I will be on the second part of the video, I'll be sharing with you the importance of a healthy reward is to risk ratio profile, and of course what kind of reward is the risk ratio profile is a healthy one. So let me walk you through the usage from our website so you know which button to click to access the risk calculator. Alright? Heading to www.forex100academy private limited, you should be able to access this website itself. I'll need you to click this registration link over here to register an account, and of course I've already logged in because this function requires you to log in itself. Head on to the tools button and you will see the risk calculator over here. So the equity in this example will be your capital. Let's say your capital is $10,000. The risk you are going to put in, let's say, is 2%, and your stop loss is around 50 pips. So a pip is the fourth decimal place for most currency. Only for yen related pair is the second decimal place. From that, you calculate the second decimal place is known as 1 pip. So 1 pip is there about $10 for dollar yen, euro yen, and stuff like that. If you want a full flat $10 and provided your account is a US dollar base, then you trade whatever dollar pair. For example, euro dollar, pound dollar, 1 pip you will earn or lose $10. Alright, so that is the pip over here. Stop loss is based on pips. So by putting in your capital, your initial risk for this trade, and your stop loss for the trade, you click submit, you will get 0.4 lot. So what does it mean? In order for you to trade with just 2% risk, the maximum contract size you can trade is 0.4. Alright, so you can double check if the calculation is correct. I've done my part of checking the system is perfectly fine. So what is this calculator on the left means? The risk over here, let's say your capital is $10,000. Your trading lot size, let's say you put a 1 standard contract. Your stop loss is 50 pips. Calculate, actually you are risking 5% itself. So you will have a situation where traders trade 3 lots, not knowing that per trade he or she is risking 15%, and they say trading is risky. Okay, so the reason why it is risky is because they have overexposed the trade itself. So for my subscriber for Trade Idea Signal itself, a recommendation for you is to trade all the trades itself. And when we say all, at times you can have experience 5 trades set up at the same time, even 10 trades set up at the same time. So if you're risking like 15% per trade in this example, risking 5 trades, that will bring your risk to 75% exposed. That is too much. It is possible for all 5 trades to hit losses and only the next 5 trades hitting winners. Alright, so it is possible to have that kind of results. So by putting my risk at 2%, it enabled me to, even I engage 5 trades, my total risk exposure is only 5 times 2, which is 10%. Alright, so when there are new trades set up, I won't have hiccups like, oh, my margin is maxed up, I cannot trade anymore. The other way of you doing it is you can just focus on trade specific or currency specific. You can trade all the euro dollar, all the pound dollar, all the dollar yen, and ignore the other trade idea signal. That's one of the way you can manage it. And of course, if you like other traders, you just want to get on board on all the trade setup that we have shared, then you have to really consider drop your risk to less than 3% is preferred, so you won't have those kind of swings itself that you are not comfortable with. So that is the first way you can use the risk calculator. The second way you can use to manage the risk calculator, let me just get back to this a bit. So you can choose to keep 50 pips as your stop loss, or you see what's the average stop loss I'm using. 50 is towards the highest end. Most of the time I won't get into that for trade idea signal. Alright, so usually it's around 35 to 40 pips. So if I bring down to 40 pips, you can trade 0.5. So one of the options you can have is you can trade 0.5 the entire month until the new equity has changed, be it increases to 12,000. Then you use the new figure 0.6 trade throughout the entire month. Okay, or even let's say it decreased to 9,000, you will be trading 0.45. That's one way. The other way is every time when you see I've posted the trade based on the stop loss, how many pips, you key in the figure, alright, on each trade, and you keep all trades remain at 2% as an initial risk based on the initial stop loss. That is one way. Alright. The other way is for you to risk based on dollar value. What do I mean by that? Let's say your account is $10,000. You are willing to only risk $100 per trade. So you risk percentage, put it to 100%, and based on $100 as your risk in capital itself, you only can trade 0.28. So it's dollar value by the risk you are taking. That's the second way you can be doing it itself by using this risk calculator. So let us move straight into why and what is a healthy reward is the risk ratio profile, shall we? So what is a healthy reward is the risk ratio profile. Just like business itself, every dollar that you're risking, you are earning more than the initial risk. That's a healthy reward is the risk ratio profile. For example, if the cost of a product is $1, definitely you have to sell more than $1 to be profitable. The idea is that. So in trading, let us see how this can significantly affect your result in trading. So in front of you, there are two reward is to risk ratio profile. Let me just walk through the first profile, which is very, very common for a disciplined trader to achieve this. So what is the reward is to risk ratio profile for that? These rectangle blocks are drawn by scale to show you the exact 1.5 is to 1 reward is to risk ratio profile. So meaning to say that if I'm risking $1, I am earning $1.50. Alright, so this is by the pips itself. And let us see, out of 10 trades, if you are a 50% trader, that means 5 of your trades are earning money, 5 of your trades are making losses, what would be your reward is to risk ratio profile? So let me just duplicate it so it looks exactly the same. Alright, let us count together. 1, 2, 3, 4, 5. So 5 trades are profitable and 5 trades are making losses. Look at this. It is after 10 trades itself, 5 are profitable, 5 are making losses. Your reward is the risk profile is 1:5 is equivalent to additional close to 2 more blocks of the additional profits you're making just by having a 1:1.5 reward is the risk profile. So why would I say that this is a common result for most professional traders? Because they might have 2 targets. The first target giving them a 1:1 reward is the risk profile. They will be shifting your stop loss at entry, and the final take profit level is at 2:1 target, which is most of the case in our company practice, in our school practice, is the target 2 producing a 2:1 ratio. Alright, so I'm saying that's why that is a very common practice. However, the other reward is the risk ratio profile is producing a 2:1 ratio. That means every dollar I'm risking, I'm earning $2 back. Over here, every dollar I'm risking, I'm earning $1.50 back. That's just an example. Okay, and let us take a look at this. If I have 5 winners, look at the big difference we have over here. Alright, it is a 2:1 ratio, that's for sure. But look at it, you can take another 5 more losses and 5 more winner, you will be having a result of this. So with a healthy reward is the risk ratio profile, traders need not to be overstressed even if they have more losses than winner. Let me show you the example. Okay. How about this trader having 6 losses and only 4 winners? Still a pretty profitable trade. If the trader having a 30% accuracy is only a slight losses. Alright, so you can see that as a way why even a 40% trader in terms of accuracy, they are still profitable. Sometimes when we talk about the trader accuracy is 40%, it doesn't necessarily mean that the accuracy is really that bad. It is possible that for a trader that is having a high reward is the risk ratio profile, let's say a 70% trader, is facing a 6 consecutive losses. Alright, even a 6 consecutive losses will bring the accuracy to 40% for the time being. Overall, let's say within a year, the trader trade around 1,000 times, they still can be a 70% trader, 700 trades profitable, 300 trades losses. Out of 300 losses itself, it is possible for a trader to lose 6 consecutive, even higher. That's nothing to do with the accuracy of the strategy, and of course, that being said, you have tested those strategies and you know the performance of that, you have backtest it, just follow through the trade. And the problem with most traders is when they see such result, they stop trading, they take a break, and that's when they miss all the winners and they say things like they are not lucky and stuff like that. Let's take a look at the 1:1.5:1 reward is the risk ratio profile. Just double checking that the blocks are correct. Yep, it's correct. So over here, 5 winner, 5 losses. Let's say you just have 1 more losses, 40% trader. Let us see how it goes. It will be a break even for 1:5:1 reward is the risk ratio profile trader if the accuracy is 40%. So with that said, 1:5:1 is the minimum acceptance for a healthy reward is the risk ratio profile. Just achieve a 50% win rate. With most of the case, trade ideas signal the trades is much higher, is hitting a much higher reward is the risk ratio profile than a 50-50 trade. I won't let you know the percentage before you go all hype up and overtrade it. Just remember that you need to leave some allowance for you to possibly take another trade. when the trade signal beeps on your phone. So apart from that, I would say that even the month of December itself, we are pretty profitable. The result for Trade Ideas is not out yet, but by looking at my P&L statement, I know it is a profitable month. Even though this month itself, the volatility is extremely low. December is well known for low volatility of the month, as most traders is taking breaks. There isn't as much financial reports as compared to other months. I do believe that on the second week of January, volatility should be kicking in, coming back, and of course, we are expecting a better results in terms of profitability as well. So with that, I'd like to end off today's session for the art of trading, speaking to you, sharing with you the importance of a healthy reward is the risk ratio profile. That's all I have for you. Till then, see you on the next video. Remember always, plan your trade and trade your plan. Happy New Year.